Yeah, I'm trying to understand when you're talking about moving the additional contribution that would be needed so that we eliminated the unfunded liability goes from 12.925% to 12.171%. So what you're saying is if we were somehow to find a way to add 12.171% to the contributions that are made on total payroll as of what you think the payroll will be January 1st, 2013?
Actually, this is all based on a 2011 valuation, just
Okay,
for
2000,
comparability.
because-
You
okay.
know, we're gonna,
I'm
yeah.
trying to, okay. I know that's where the 12.925%, but see, what I'm trying to understand is, so when you go to 12.171, are you applying PEPRA to the 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 analysis you did as of June 30th, 2011? And if so, what assumptions are you making about what percentage of the teachers in the system are under PEPRA? Because at that point in time, none were.
Yeah, that's good. Yeah, that's kind of a fine point. But yeah, so we have applied it to June 30th, 2011, and then then we do our projections. We take the payroll forward and apply the contributions. So what we've done is we've assumed that teachers tend to hire on, at the beginning of the school year. So we've assumed that, January 1st, 2013 doesn't really mean that much difference than July 1, 2013. So we've assumed 2 years where all the payroll falls under the current plan, and then effective January 1st, 2013, we've done our projections that we talked about with Paul, with Michael, excuse me, that where we take people out, people die, people retire, people terminate, and then we assume they get replaced by new teachers, okay? And so those new teachers, we have new payroll for them. So we bring in those new teachers, we bring in new payroll. So we've got a declining payroll for the current teachers, and then it's supplemented by an increasing payroll for the new teachers. Does that make sense? So we basically follow our actual assumptions to project our population forward as we expect it to be, taking people out with retirements and terminations and replacing with new teachers that do fall under PEPRA. And that, in our projection, we're starting as of, this is like a 30-year projection, but we actually don't start until 2 years in the future to bring in those new teachers.
Okay, I guess I'm trying to understand then if that analysis incorporates expectations in the future of teachers under the old rules retiring and new teachers under the new rules populating the system. Why over time, you're suggesting that over time that 12.171% number will be coming down?
No,
Or no?
no, that's not, yeah.
Then in other words, you're suggesting that the long-term impact of PEPRA is that what we need to do to solve the unfunded liability has gone down from 12.925 to 12.171.
That's exactly right.
Okay.
Yeah, so there's kind of two
So
pieces.
we can't expect that 12.171 is going to keep declining if we just wait.
Right.
Got it.
That recognizes
That's
that
what I wanted
over
to
a
be clear
30-year
about. Thank
period.
you.
So it's
Thank
like
you.
we fully recognize
Thank you.
over a 30 period. And as we've told you, that number's going to move up and down, based on obviously investment experiences
I
in
understand
retirement.
that, but I'm just saying, we can't expect that the unfunded liability problem just goes away because over time.
No.
No, but it was not clear in the way they wrote that. So that the improvement from 12.925 to 12.171 is the impact. We're still left with a 12.171% problem that we have to address.
Yeah, if we took it over.
I just wanted to clarify that.
Yeah, if we took it over 50 years, it'd be a different, type thing. But as we said, based on that 30 years, it's not gonna
Right.
improve
I understand.
measurably.
I
About
just-
0.75%. Nick and I were talking about this morning, and I said, well, I think maybe we should have
drawn this graphic a little bit different and showed the arrow missing the target. I mean, if the target is to solve the funding problem, we're missing it. Nick said, well, no, actually, the arrow should just be falling short. So, I mean, and I think this is, in terms of the funding problem, this is the most meaningful slide, is this is not a solution to the funding challenge that CalSTRS has.
Ed, did you want to
Yeah,
weigh
just
in on that?
for one
as well?
thing for Nick and for Mark, just to clarify, but assuming all of our assumptions hold, that after 30 years, that 12.171 contribution rate would no longer be required. Then all
Yeah.
we would require is just the contributions to cover the normal cost.
Yeah, in a perfect actuarial theoretical word. Yeah, exactly.
In 30 years, we'd have run out of money.
No, if we increase contribution rates by 12,
Yeah.
right, that's what I'm
If
saying.
we increase-
No,
Yeah,
that's what I was trying to say.
But that's what he said.
Right.
If we increase
Yes.
to 12.171.
Right. By
for
12.171.
For 30 years.
Right,
Right.
That, and all of our other assumptions prove to be correct.
right.
Then we don't need that addition, then after 30 years, all we have to do is contribute the normal cost.
Correct, right.
At the end of 30 years, we'd be 100%
Right.
funded, and since by 30 years from now, the majority of the members would be under the new
Right.
plan, we'd be contributing the normal cost, which would
Right.
be close to 15.9% of pay.
Right.
Alrighty,
We good?
we're good.
Okay, let's move forward. So this is the recommendation, which is really similar to what you have in your agenda item, minus one thing. And obviously, our recommendation is you adopt the new member contribution rate, which is equal to 8% of credible compensation based on it being half the normal cost rate. Adopt the new normal cost rate of 15.9% of credible compensation. Now, the member rate actually affects something right away. It affects the member rate. The 15.9% really doesn't have a direct impact on contributions unless you were to set the district rate based on, change the district rate from the 8.25%, which under staff's recommendation is to leave it at 8.25%, which we believe is a reasonable approach. We're not taking a position on that. That's why we didn't have it on our recommendation. But so that summarizes our presentation.
Alrighty, so the recommendations are on page 59.
I'm sorry, I have one more
Go ahead, Paul.
question. So what authority, and maybe this is a question for Brian or for Ed, what authority does this board have over setting employer contribution rates?
There.
It's in the bill. The bill specifically, if you look at page,
Oh, that's right. For current,
TRB
you're right.
64, section 7522.52. It talks about the public employer's contribution to the plan shall be not less than the normal cost rate after you take into consideration the member contribution. And part of the difficulty with this is that language is applicable to, as you said earlier, us, CalPERS, county retirement systems, and quite honestly, part of the issue is whether or not they in fact really intended to have it apply to us, because it's such an unprecedented thing to have this board set the employer contribution rate. But reading it literally, it suggests it is. But we really want to get that clarified. Did you really mean to do that? Because there's a number of issues associated with setting a contribution rate of 15.9% minus 8 for the employer, because we're going to be collecting less money than what we're collecting under existing law. And the statute, our statute hasn't been changed. It still says it's 8 1/4. So there's a lot of things, so there's a number of reasons which you can go into as to why what we're recommending is just keep the contribution rates the way they are under the statute. So it's 8 and 8 1/4. Get clarification from the legislature about some of the issues, even the issue that Michael raised, trying to get clarification about how we calculate the normal cost rate. But before we go ahead and change the contribution rate, because to do otherwise, we would be making a number of changes to our systems and employer systems that may be completely undone if in the extreme, they never intended to give us that authority to begin with. When we had discussions with legislative staff as Pepper was being developed, it seemed to us that what they were planning on doing was addressing the CalSTRS contribution rates in the context of the larger funding plan of CalSTRS and not trying to deal with it in here, but that's not the way it ended up getting drafted. So we want to get those issues resolved before we start making a lot of changes in what people pay, just, for administrative prudence as well as, quite honestly, for the funding of the system, because if we reduce the employer's contribution rate the 7.9%, that's the minimum suggested. It's not, it isn't the absolute number, it's the minimum suggested. We would be collecting less money than what is being collected under current law, and obviously make our situation worse.
Maybe you can point it out to me again. I don't see where in this statute it says that we take any action with respect to what the employer's contribution rate is. It just says that the employer's contribution to a defined benefit plan in combination with employee contributions to that plan shall not be less than the normal cost. So why do we have to take any action at all? Because why doesn't the 8 1/4 just stay in place? Because that meets the legal requirements here.
Right, that's an excellent question. That's a question that we asked when we looked at it. It's one of the questions we asked in trying to interpret it. And that's why it needs clarification. It also says not less than. And so, going to Paul's point, Michael's point, going to that number, what is who determines that? Who determines what, if it says not less than, who determines what it's more than? And what factors do you use? And do you have authority, as Michael pointed out, to adopt regulations? Well, there's nothing this is in the government code, there are so many legal issues with this, so based upon that there's not a whole lot of authority granted in this.
Yeah, and I guess I'm wondering why this board is then even taking any action on what the employer contribution is, because why doesn't the fact that the law right now says 8 1/4 just apply? It satisfies the language here in PEPRA, which is that, their contribution in combination with the employee contribution shall at least be the normal cost. We satisfy that requirement. So I'm just trying to understand why this board has to take any action whatsoever on the employer contribution. That's all.
Thank you, Madam Chair. I think there was several questions have come up that clearly it's 340 sort of did not address, and there are some legal questions that in my mind are still outstanding. And for that reason, I'll need to abstain from voting on this particular issue. I'm not there yet. Thank you.
All righty. So we have our 3 recommendations. I'll entertain a motion. Yeah, they're on 59.
Where are they? 59?
Jennifer, I'm sorry. I thought you had sat back down. Go ahead.
Good
Before we
morning,
vote.
Jennifer Baker with the California Teachers Association. I just wanted to reiterate the comments that Ed had made earlier, that there are aspects of this that will likely be clarified in legislation. We look forward to having those conversations with the legislature next year. But I also wanted to make a note that there's some very sensitive issues that can have very large ramifications in the legislature, and that some of that resolves around the board having the ability to set or increase contribution rate. It's a very, very sensitive issue, particularly in the legislature, and they've been absolutely clear over the years that that is their purview and not the purview of this board. And that's certainly something that the California Teachers Association does support, and something that retirement advocates coalition members have discussed over the years. We're also very sensitive to conversations about increased teacher contributions. It's a very sensitive discussion that the legislature is going to be having. We're going to be having ongoing discussions, but as you can imagine, all of these don't only impact CalSTRS. These also have impacts on the classroom, and we have to have a large, broader discussion, and we're somewhat concerned that we're getting into the minutia, and that can begin to deter our ability to have comprehensive discussions with the legislature and with you on how we move forward building trust.
Thank you, Jennifer. Michael?
Since I seem to be channeling Paul today, I'm not sure I heard an answer to Paul's question, which is why we should be taking an action with respect to setting employer contribution at all. And doesn't it shouldn't item 3 of the staff recommendation be taken off the table? I mean, I guess what I heard from you, Brian, was, yes, a question, but I think we need to hear from you a recommendation as to whether we take it off the table or whether we go forward and why that recommendation is being made. I mean, if you're recommending that we adopt all 3, I guess I'd like to, I think we,
Let me put it this way.
okay.
We have the recommendations from staff. We don't have to move all 3. So, Brian, if we don't move item number 3, the third recommendation, then the employer's contribution just remains at 8.25.
That's correct.
So it's up to us.
And if I could suggest what might be good just for the record is maybe make a finding in the resolution that pursuant to the education code, this is the employer contribution rate.
This would be
Just so that it's clear to everybody, that's what it is.
And I guess what I'm asking, and what I thought Paul was asking was, not necessarily a legal opinion, but just, does this, I understand we could do that.
Okay.
Does our legal counsel believe that that makes sense? I haven't heard him say yes or no.
I ask our fiduciary counsel for his opinion.
The way the statute works, by setting the normal cost, you're effectively setting the contribution rate. So I don't know what it gains you by not voting to set the contribution rate. You're still on the hook for setting the normal cost, which sets the contribution rate, but, technically, I have no problem with just setting the normal cost. And then doing what Ed suggested was just as to point out that the result of you setting the normal cost is what the contribution rate's going to be. I don't see where there's a difference.
No, not for the employer.
Not for the employer. I mean, if we're setting the normal cost at 15.9%.
Right.
Then according to PEPRA says that it shall be at least half of that.
Right.
But that doesn't set the employer cost then at 8.25%.
That's in conflict with the ed.
It's in conflict.
It's in conflict with
It's
the
in-
law.
it's-
Problem.
Right, that's
in conflict with the contribution rate
that's
is
the
in law.
problem. I mean, the law before PEPRA, and this wasn't changed by PEPRA, says that the employer contribution rate is 8.25%.
Right.
Right? So where do we have the authority to take any action on the employer contribution rate? I mean,
For current members or for new members?
For employers.
for employers, for new members,
For employers.
with respect to new members, yes.
Correct.
Right,
The way it works is you set the normal cost,
right.
and then the employee and the employer, for new employees, split the contribution.
Well, but that's not what's come before this board, because what's come before this board is not 7.95%, which is half the normal cost, it's 8.25%.
Yeah.
But it says at least.
And that's an excellent point. We talk about setting the contribution rates, but that's not what the PEPRA says. PEPRA says that the contribution rate shall be, what this board does is this board, as part of its ordinary course of business, sets the normal cost. Then those dominoes fall. What legal counsel has recommended is that the current scheme under PEPRA doesn't change the teacher's retirement law. There's nothing in there that gives either instruction or authority to go in there and start tweaking the statutory contribution rate of the employers, and it's especially unclear, as I mentioned last time that we talked about it, when that starts applying. Whereas when you talk about the employee, it talks about they shall, as of January 1st, 2013, they shall pay the normal cost. But it doesn't say, and CalSTRS shall set, have the normal cost, but CalSTRS shall set the rate. It just says CalSTRS shall set the normal cost. So the statute, one of the problems that we have with the statute, it's not self-executing. It doesn't, so it needs more for it to work. And it doesn't have a grant of authority to supplement it with regulations. The other part of this, of the problem is the whole legislation in the front says, guess what? We know that this isn't going to work perfectly, and we charge you to provide us with recommended changes and tweaks to the statute to make it work. So as we look at the statute, it's sort of a one-size-fits-all that doesn't fit us at all. And so yeah, we kind of get hung up in the details, but Ian is absolutely right. We just have, you just have the authority to set the normal cost. The others are assumptions, but there is no specific grant of authority in the government code, and there's certainly no overturning of what's already in the teacher's retirement law. And that's part of the reason that, at least the recommendations, is to go back and get clarity. Number three, you know, I don't believe that the statute says that we set the contribution rate. I think in some of the discussions that the, you know, the dominoes have been collapsed. So rather than 1, 2, so it says we set the normal cost and then the contribution rate shall be, and that's just been collapsed. And so I think at least in some of the shorthand that's being used, it says, well, we set the contribution rate, but we don't. We set the normal cost rate. And then Pepper then goes in and says, here's what the employee contribution rate, and we think it says, here's what the employer contribution rate will be based upon the normal cost that CalSTRS sets. And that's the reason for confusion. And really the recommendation from legal is to leave everything the way it is and go back and try to figure this out. Right on?
Yeah, but to charge, but, you know, to go with a higher, not the 7.9.
Yeah, it's certainly not, when we're in doubt, certainly not to start cutting the amount of money
Right.
that comes into the fund if we don't have any clear authority to do that.
Harry?
I'm ready to move staff's recommendation. I think item number 3 provides us the last 2 sentences, or the 2 lines there, the rate specified in 229050 and 22951, Ed code as a total of 825 until further clarified by the legislature. I think that essentially gives us it addresses the concerns that have been raised. Mm-hmm. It acknowledges the fact that further clarification is necessary. Until further clarification is provided, we're going to honor the Ed code. And the Ed code clearly states that the employer contribution rate is 8.25%. So until further clarified, I think we should move staff's recommendation. And as additional information and clarification becomes available, we should be educated and informed as to what that is.
Second. So it's been moved and seconded. Michael?
I would proffer an amendment to that motion that we change the word establish to confirm.
Is that a friendly amendment to you? That we confirm pursuant to that code? Brian, does that change the intent too much?
No, I think based upon what Mr. Keeley said, I think, you know, you need to read it into the fact that we're really just pointing out that that's what the contribution rate's going to be based upon those statutes.
Yeah, I want to make it clear that we're not taking any action
And
because we don't,
Right.
based on advice of counsel, we don't have the authority to affect the employer contribution rate.
so I have no problem with the change. I think it works.
Yeah, and I just want to, can I?
Yeah.
in looking at the third recommendation, which is the subject of the discussion, the intent of my motion to support the staff recommendation is simply that we're honoring what is currently and historically has been in the California Ed Code. The reform, pension reform, like many laws, are passed, and after the laws are passed, there are inherent conflicts with other laws. And what I'm simply suggesting is we honor the law of 22950 and 22951, and then the last sentence says until clarified further by the legislature. That's really what I'm getting at, the intent of the motion.
So Brian, let me try to do something here, because I want our record to reflect what we've decided. So even starting that third item pursuant to the 75225.52 should be taken out, because we're not doing this pursuant to that section. So it seems to me that our record should read that pursuant to sections 22950 and 22951, that we reaffirm or we,
I would say,
you said confirm?
I said confirm, but I was thinking
Acknowledge that initial, then we can go on to say that an initial CalSTRS employer contribution rate for credible comp paid to any member first employed after January 1st, 13, be a total of 8.25 until further clarified by the legislature.
Yeah,
So
Jane, I
we're-
would just take out the word initial and just say it's an employer contribution
Okay,
rate.
an employer contribution. So we take out the reference to PEPRA in the item and reaffirm what we're basing our decision on. Does that make sense to you?
Can we read it just one more time?
Robert, did you kind of get where we were going with that?
Robert's doing it without the printed material in front of him, so we'll try to pull that together.
We can read it back in though for everybody.
So we'll give you a couple minutes.
Okay, we'll work on three. So it's just
You know what?
education code.
I think this is a good time for the board to take a recess. So let's go ahead and recess for a couple minutes and let you guys get some wording together for us. Oh, Steve, you want to talk first?
Point of information, maybe it's my hearing, I'm getting old. I never heard a second on the amendment, so I'm.
Second it.
Oh,
It was,
thank you.
it was a friendly amendment, now we're just
Okay,
trying to
great,
work
I
the
just couldn't
wording.
hear it, thank you.
My voice better next time, Steve.
Thanks, Steve. I am so glad that, you're keeping my parliamentary act together up here. Thanks. Okay, we're going to recess for 5 minutes. Because of, due to our conversation and the comments that have come up, we're also thinking about making a revision to the recommendation of number 2. So what I'd like to do is go ahead and move on to the next item. We'll revisit the vote for 7, even though we have a motion on the floor, as long as there's no objection to move on. There's been some other suggestions, and so we'll take a look at that when we have some language before us. Is that okay with everybody? Alrighty. So let's go on. I think we are on item number 9.
Financial statements.
That ought to give everybody enough time to do what they need to do back there. Nick, Mark, thank you very much.
Always a pleasure.
So, good morning, and it's my pleasure to introduce Art Martinez, who's our Assistant Chief Financial Officer, and he's going to present the results of our fiscal year 11-12 as presented in our financial statements. We talked in the ARM Committee about the fact that we were reviewing the process and the feedback from the auditors, but not actually going through the financial results, so Art's here to do that.
Good morning. Today's presentation is an overview of the financial statements and the results for June 30th, 2012. Before I get started, I'd like to thank all those that were involved in the preparation of these financial statements. It really took a cross-organizational group of staff from primarily investments, actuarial services, financial services branch, and benefit and services, and then others also in other parts of the organization. The other thing I'd like to highlight is that we made significant improvements in the timeliness of preparing the financial statements. We actually cut down the time from 3 months, which is what it took us last year to prepare the financial statements, down to around 50 days this year. So that's in light of all the manual processes that we currently have in place to actually compile all this data. So with that said, what I'd like to do is move on to the main part of the presentation. What I'm going to do is give you sort of the presentation is going to sort of follow in alignment with the way the financial statements are actually structured. So at the same time, what I'll do is give you an overview of each one of the parts and then go into some additional or a deeper dive into some of the information that's actually presented within the numbers. So the audited financial statements are comprised of a number of components. First, it has an independent auditor's report, which was discussed in the ARM committee. And this is a report in which the auditors render an opinion on the financial statements and whether or not essentially it's free from material misstatement. The next section is the management discussion and analysis. And this really sort of is an executive summary of the financial statements that includes an overview of certain risks, financial events that took place during the year. It also includes a condensed set of financial statements. Next, we move on to the basic financial statements, including notes. The basic financial statements for a pension plan include a statement of fiduciary net assets, which is essentially equivalent to a balance sheet, and also a statement of changes in fiduciary net assets, which would be equivalent to an income statement. The notes to the financial statements really go to provide supplementary information to assist the user in understanding the financial statements, the policies that we have in place, and provide additional details in terms of what occurred during the year. Required supplementary information for the financial statements includes primarily its actuarial information regarding the funded status of the plan and also funding progress. It includes historical information on contribution rates, annual required contribution information, et cetera. And then the last section is other supplementary information. In here, we have more of a detailed breakdown of the administrative costs or administrative expenditures of the plan, and also the investment expenses that actually are incurred for managing the investment portfolio. So with regards to our management discussion and analysis, it provides an overview of financial activities for the year and a narrative on known facts, uncertainties, and risks. And some of the things that we discussed this year in the MD&A overview was the board's strategic goals and changes in board composition, the DB funding issue, pension reform developments, and upcoming changes in GASB pension accounting standards, and finally, business renew. Moving on down to the funding analysis. The funding analysis, within this section, we really discuss the funded status of the DB program. Furthermore, within that section, we include a sensitivity analysis that looks at changes, the changes that the investment rate of return would have on the funded status of the program or funded ratio. This isn't required information to be presented, but we feel that it's useful for our user of the financial statements to have a better understanding of the plan. Going forward under the new GASB pension reporting requirements under GASB 67, similar information will be required to be disclosed. In the investment section, we provide information on the investment asset allocation. In addition to that, we also have information on asset class performance returns compared to the benchmarks. And finally, we discuss a little bit about the investment rate of return, which this year was 1.8%, calculated on time-weighted performance basis. Going forward, again, this information isn't necessarily required, and we include it just, again, to provide the user of the financial statement additional information to help them evaluate the plan. Going forward under GASB 67, this information will be required. However, the performance or the return calculation will be required to be done on a time-weighted money basis. So there could be differences actually between what we're showing in the financial statements as the return for the investment portfolio and what's actually being communicated out in terms of the return from a performance standpoint. Now, moving on to the statement of net assets, this is the set of condensed financial statements that are in the MD&A. So it rolls up a lot of the information out of the basic financial statements. And I think the message I would impart on you is when you look at this, you can really see the impacts the economic environment has had on a mature plan where the benefit payments are outpacing contributions and investment returns have been rather flat. It's really resulted in a need for us to really focus on cash management activities, ensure that there's sufficient liquidity to meet benefit payments as they come along. Going down through some of the line items, I'd like to focus on a couple or a few. As you can see for investments, the investment values decreased by about 4%. Moving to cash and cash equivalents, you see a 281% increase in that. And really that has to do with ensuring that we have sufficient liquidity to pay benefit payments as they come due and tax payments. For us, the cash that we actually had in the banks was about 127 million, so the remainder was cash equivalents. And for financial reporting purposes, we consider any highly liquid highly liquid instruments with original maturities of 90 days or less as cash equivalents. Moving on to investment receivables and member and employer receivables. Those essentially change due with timing. So on the investment receivables, they can fluctuate based on open trades and when things settle. Member and employer receivables will change depending on, service credit purchase, overpayments, et cetera. With regards to capital assets, there wasn't a significant change. And the major capital asset that we have on the books is actually this building. Moving down to the benefits and process payment, you can see that there was a pretty large change with regards to that liability, a 91% decrease. And this has to do with the timing of when the benefit payments were made. Last year, the June benefit payment was made the following fiscal year on July 1, whereas this year, the benefit payment was made June 29th, so before year end, so the liability was liquidated. Again, with investment payables, that'll fluctuate depending on open trades and when things settle. Moving on to the TALF loan payable, for those of you that aren't familiar with this, it's Term Asset Backed Securities Loan Facility. And it was a program that was implemented or created by the U.S. Federal Reserve a few years ago to spur consumer credit lending. TALF provided non-recourse loans collateralized by newly originated or existing securities that met specific credit quality and other program requirements. And the outstanding TALF loans have remaining maturities of 2 years. One of the new items that we have displayed on the financial statements this year is the Master Credit Facility Payable. And in fiscal year 2011-12, CalSTRS entered into 3 separate unsecured credit facilities for the real estate core investment strategy. The proceeds from the Master Credit Facility portfolio provided a source of funds for managing capital flows of investment strategies. As of June 30th, 2012, the total available line of credit in the Master Credit Facility portfolio was $1.4 billion, of which $995.6 have been drawn down. Now, when you look at the TALF and the Master Credit Facility Payable, generally when you look at the investment portfolio, these would be included in the net asset value of the portfolio. But for financial reporting purposes, under our accounting guidance, we're required to break those out from the investments and actually display them distinctly. Now, moving on to other liabilities, again, there was an increase of about 160%. And that is primarily due to the timing of tax payments. So we had tax payments at year end within our ZBA accounts, which the IRS and franchise tax board had not pulled out. So when you look at total net assets, you can see that there was a decrease from 155 down to 151. And the decrease, when you look at it, is mainly attributable to the shortfall between benefit payments made and the contributions received. This gap has historically been filled by investment returns, but to the extent investment returns are not able to make up the shortfall, investment assets are liquidated to make benefit payments, which causes a corresponding decrease in net assets.
Before you,
No, you're right.
can you go back to the
Sure. Oh, this,
Yeah, the balance sheet.
previous.
oh, okay.
Thank you. On the master credit facility payable, is there a change? I think you said you normally have this as part of the assets and, I'm sorry, that's $1
Well,
billion. Can you explain
Right,
that?
just when you look at the value of the investment portfolio, when it's communicated out, this liability is typically wrapped up within the net asset value of the investments. So, but for financial reporting purposes, we're required to break it out from the investment values and display it distinctly on the on the statement of net assets. So it's just really, it's sort of represented in a different place that you would otherwise see it.
But is that different in presentation from prior years or?
No. Last year, we did not have it. This is new for this year, for 2011-12.
So it's $1 billion liability that we didn't have.
Right, so when you look at the 2011 column, you see that dash there. That
Right.
dash represents the fact that it didn't.
I can read that table, but it was like $1 billion just strikes me as a big credit liability that we shows up for the first time. So, thank you.
Moving on to the statement of changes in net assets. Member employer contributions decreased by about 3% over the prior year, and this is consistent with the trends that we've been seeing. Because we don't have visibility into the actual payroll costs at the district level, we generally have to rely on the contributions that are credible comp figures that we receive to get an understanding of the decrease. And based on the information we have and assumptions made, we would assume that it's because at the school district level, the payroll costs have been reduced because of either teacher layoffs or early retirement incentives or things of that nature. The state contributions increased by about 9%. And the reason for this is in the June 30th, 2010 actuarial valuation, there were certain provisions met that required the state to have to contribute an additional $142 million in general fund contributions. Of that amount, $106.5 million was received this fiscal year, or fiscal year 2011-12. Regarding investment income, I think we're well aware of the losses, decrease. Now, with regards to benefit payments, you can see that there's an increase of about 6%. Again, this is consistent with the trend that we're seeing in a mature, in our plan, which is a mature plan. We're seeing an increase in the benefit payments each year. Looking at the refund contributions, there was a decrease of about 7% over the prior year. Looking at this last year, there was actually about a 16% increase in refunds. So it's good that we're seeing an actual decrease because it's more of a trend towards retirement security. And then the administrative expenditures increased by about 25%. And this is primarily because in 2011, we had the reversal of an accrual for furloughs that we were expecting to pay, but once the court case came out, I guess negative or opposite way, we reversed the accrual, so it reduced the expenditures for that year.
For 11, yeah.
For 11. Okay, now looking at pension two, the net assets increased by 46 million over the prior year. Contributions increased 11.5 million, and there was an 8% increase in membership. Net investment income decreased by 37.6 million. The one thing I want to say about pension two is that the contributions that are coming in this year were much greater than the actual distributions that were made. So that's why you see an increase in the net assets. For pension two, the investment returns were pretty flat. One of the interesting aspects of this program this year is that we entered into an agreement with LAUSD to provide them both record keeping and administrative services for their 457 plan. However, because they maintain significant fiduciary responsibility over the investment activities of that plan by selecting the fund options they provide and also monitoring the fund performance, we did not include them within our financial statements, but rather disclose the nature of our agreement with them within the notes. Moving on to the Teachers Health Benefits Fund. This fund is used to account for the Medicare Premium Payment Program. The program is handled on a pay-as-you-go basis, So typically, when you look at the net asset decrease, it's not anything to be alarmed with because we generally try to maintain a small reserve within that fund of 600,000. Again, because it's handled on a pay-as-you-go basis, the contributions will generally be in alignment with the benefit payments that are made out of that fund. The Teachers Deferred Compensation Fund is a fund that's used to account for the ancillary costs associated with the deferred compensation plans that we provide. Within this fund, we account for the 403B Compare and the 403B Comply program. So looking at the revenues increased slightly, and that was because fees charged to vendors were increased for the year. Now, looking at Note 1 for the financial statements, this really provides a reader an overview of the different plans and programs that we administer. It gives them an understanding of CalSTRS as a whole and the membership that we serve. Furthermore, it provides them information on the different contributions that each plan receives. With regards to Note 2, this really provides a summary of the various or different accounting policies that we have. Just to touch upon a couple of them, the basis of accounting that we use we're accrual-based. We follow generally accepted accounting principles. Cash and cash equivalents, I talked a little bit about earlier regarding what we consider cash equivalents. With regards to investments, within this note, we provide a reader information on the various methodologies that are used to fair value the investments as reflected on the financial statements. Our capital asset threshold is set at $1 million for both intangible and tangible assets. Moving on to Note 3. This note really provides information on the funded status of each one of the programs. Most of this information has already been provided to you probably in the spring. So what I'd like to do is just touch upon some of the differences that you'll see in this data compared to what was presented to you during the actuarial services presentation. Under this, for the defined benefit program, the unfunded liability increased by $7.8 billion. And these figures will differ a little bit from what was provided to you because for the purposes of the defined benefit program, we exclude $635 million that's associated with the MPP program. The reason that we do that is because including that liability within this data right here would essentially be double counting it since we disclose that liability within the Medicare premium payment program. So if you move down and look at the Medicare premium payment program, you'll see that there was no change because there hasn't been a valuation done. And the funded ratio for that is still 1%. And again, this will differ from what's presented to you, presented in prior board meetings regarding the program from a funded status. Because in that sense, it looks at the program as fully funded. However, under accounting guidance, GASB 43, we're required to show it as unfunded because we don't have the assets actually set aside in a separate trust. Moving on to Note 4, this provides a reader information on the risks associated with our deposits and investments. Some of the information that we describe within this note is the security lending program, the transactions, the amount of collateral that we've received, the fair value of that collateral, and et cetera. We also provide information on real estate investments and the related debt. Within this note, we have a debt service schedule that details the actual outstanding debt associated with the real estate portfolio. And the principal balance of that debt has decreased by approximately $72 million since last year, and the balance at 6/30/2012 was $10.2 billion. Also within this note, we provide information on different risk schedules associated with essentially our fixed income and derivative instruments. We provide information on credit risk, interest rate risk, concentration of credit risk, and foreign currency risk. And there were no significant changes in the information presented in these tables this year compared to last year. And then finally, with regards to our derivative instruments, under GASB Statement Number 53, we're required to disclose a number of different bits of information on the derivatives. And this year, the net fair value of our derivatives was approximately negative $1 million, which would have indicated that we were in a liability position at year end. Moving on to some of the other notes. Within Note 5, we disclosed any contingent liabilities that we have. And for this year, we had no significant contingent liabilities to disclose or accrue. Note 6 describes the commitments. Our unfunded commitments with regards to our investment partnerships was $15.7 billion. Our commitments associated with the credit enhancement program was $1.8 billion, expiring through November 2015. And then the commitment for the MPP program, again, is $635 million. Now, within Note 7, we describe subsequent events that occurred after the issuance or after year end. And this year, what we discussed within that subsequent events disclosure was the passing of the pension reform legislation, Assembly Bill 340. With regards to new accounting pronouncements, the only one that came out this year that could have potentially had an impact to us would have been GASB 64, which dealt with the application of hedge accounting termination provisions. Because all our investments are accounted for at fair value, we do not use hedge accounting, and therefore, even though we may have derivatives that are used for economic hedging, they're still fair valued on the financial statements, and therefore this wasn't applicable to us. This coming year, we have approximately 5 new GASBs that are out that we're still evaluating to determine what the impact is to us from a financial reporting standpoint, but we don't expect anything major or significant to come out of that. And then the other two, I think you're well aware of and that have been discussed in the ARM committee. It's GASB 67 and 68. Now, finally, the last part of the financial statements, or towards the tail end, is the required supplementary information. And here we pulled out some of the information regarding the annual required contributions. Again, the annual required contributions are the amounts that would need to be contributed to fully fund the program or to bring the program to fully funded status. The ARC increased for the DB program from 6 to 6.2 billion. When you look at the contributions that were actually received compared to that, it was 46%. Under the new GASB reporting requirements, we'll no longer be required to provide this information. So this will actually be going away.
Or maybe in the MD&A.
Or maybe in the MD&A. So with that said, that concludes the presentation. And do I have any questions?
I don't have any, oh, I do. Go, Paul.
Thanks. Thank you very much for this presentation. Just a question, going back to something you said earlier, was that the way for financial statement purposes we're going to be measuring investments will be changing and will be different than the way the investment staff measures their return. Can you explain a little bit about what the changes will be and if we have any idea what the likely impact would be?
Well, I can discuss the changes and maybe Robin can discuss the potential impacts. But but essentially under
I was using you as plural, so whoever answers is fine.
With regards to currently under financial reporting guidelines, we're not required to disclose the investment rate of return for the portfolio. Under new accounting guidance, under GASB 67, we'll be required to provide that information calculated on a money-weighted rate of return. And I think we're also going to be required to provide that information over, I think, a 10-year
Yeah, there's a
time.
10-year look back.
Right. So because we're using the money-weighted rate of return calculation and investments is using a time-weighted measurement, there potentially could be differences between the two figures.
Can you explain what the difference is between money-weighted and time-weighted? I thought investment return was a function of both money weighting and time weighting.
So again, there are two different technical methodologies for calculating return. One places more emphasis on the actual accumulated balances versus the holding period. So they are still clarifying how they want us to determine a money-weighted return, which is less classically defined in the environment as a whole. I think it can have the impact, depending on the situations, of either raising or lowering the return as compared to a time-rated return. And there can be situations where, depending on how money flowed, you would see a significant difference. I think the point that we wanted to make in terms of going through the details here is for you to understand that as GASB 67 and 68 are implemented and the requirements that are being placed on us, both from a actuarial and investment performance basis, we're going to see divergence in the information that our stakeholders receive. They're going to see multiple sets of numbers. And those numbers can be divergent in either direction based on the circumstances at the time. So we'll have funding numbers and we'll have investment numbers in the financial statements. And those are, I would say, 99.9% likely not to be the same as the numbers we're hearing from a performance basis or from a funding perspective. And so that's the point of us going through this with you. It's also the reason that we've taken so much pains in the MD&A to make certain information available to readers so that they can begin to get used to the fact that the financial presentations and the presentations for other purposes are going to be divergent. So again, GASB we have been active with GASB in at least providing input to 67 and 68. They have reached out to us and asked us to participate in the implementation guide review, and we will do that so that we can make sure that we've got clarity in terms of the calculation methodology, which again, for money-weighted returns, is not very well clarified in the industry. It's just not something that's out there in the same way. As we talk to our custodian and figure out how they can calculate for us, it's going to be a new thing.
So is that, would we be calculating, and right now we're not showing investment return in the financial statements.
We
We're
only
showing
have to-
investment income.
Well, yeah, the financial statements themselves do not include the investment return. We do have it in the MD&A, and because that MD&A is reviewed by the auditors, they're also reviewing that performance calculation, at least as it's presented to a reader. It's not part of our audited financial. Sure,
My
I'm
question
sorry.
is, so is the way in which we measure investment income going to change? Because we now do report investment income. So is the fact that we're going to be, that the investment staff and the financial statements are going to show investment returns potentially different, rate of return potentially different, does that also mean that the dollar amount of investment income will be different? Could be different.
So I'm going to answer that in a more complicated way than you asked the question, because GASB currently has a technical project to look at how investment income and actual investment assets are prepared by government entities. So it's not associated with GASB 67 and 68. But again, it's something that Kevin mentioned on Wednesday afternoon, this technical project. And that project appears to be trending in a direction where the way we account for things now is going to be the direction that the mandate is going to go. So we basically rely on FASB to a large degree for our investment assets, because we have what I'll call exotic enough assets that we need to have some basis for the accounting. And so we already use FASB for that valuation accounting standard. And it appears that GASB is going to basically go in that same direction. So my complicated answer is it doesn't appear that we will be changing our presentation because we are already in alignment with the direction that GASB is going.
I'm not talking about presentation, I'm talking about calculation.
Well-
I mean, is it possible, I'm trying to understand what we are likely to see change and what we are likely to see might be different between what we're getting from an actuarial or an investment staff perspective and what we're getting from financial statements. So we're being told that there will be a different method of calculating investment rate of return. But does that mean a different method of calculating investment income, the dollar amount of investment income? and the dollar value of investments.
I would say generally, I don't think that it'll change the way income's measured for financial statement purposes, just the way in which the returns are reflected for financial reporting purposes.
And I guess my hesitation has to do with there already are some nuances. So again, when we think about accounting in the performance management arena or the investment management arena, that's already different than something that we do on the accounting side. So I just don't want to leave you with the impression that they're even currently exactly the same.
Yeah.
They're not.
There's some subtle differences.
Yeah.
All right. That's the last speaker. Do you have anything else you'd like to add, Art or Robin?
No.
All righty.
Thank you.
Thank you very much. Do we want to return to 7 yet, or do we want to move on? Brian, are we ready to return to 7, or should we move on? Okay. All righty. So Janice, Graham? We'll take a look at the business renew oversight stuff. Good morning, good morning.
Good morning. Okay, thank you, everybody. So we're going to go through a normal process of talking about each of the active business renew projects. The slides that you have in front of you are based on the final version of our October oversight report, which was dated October 31st, so the very end of the month. In some instances, things have happened just in the last few days, so I'll talk about those verbally as we get there. But we'll dive right in with the CALM project. So when we spoke in September, I'd reported that the project team was undergoing a replanning exercise. They were looking at the schedule, which at that time was a November implementation date. And in mid-September, the project concluded with a decision to revise the implementation date to December 17th of this year. So they went through that process with the steering committee to approve that change. At that time, and our sort of recommendations as we were doing our work in October, was that we still felt that schedule was pretty aggressive. It didn't leave a lot of room for delay, and any delays would probably cause an additional delay to the project. So we provided a set of recommendations at that point, and the recommendations at that time were the ones that are on the slide here. So the first was that there was a key deadline on November 5th, last Monday, when the project was scheduled to transition from the first cycle of integration testing and complete that cycle and move into the second cycle of integration testing. And so we'd recommended that that be basically a go, no-go checkpoint for the project, that at that point, depending on progress, they make a decision about whether the December 17th date was in fact achievable. And in advance of that date, to develop a contingency plan in case another schedule change would be required, and then clearly communicate to all the project stakeholders what the plan was, and if there is going to be a need for a change, what the change was. The project leadership agreed with that, and they were heading in that direction anyway. And so the project did set a milestone date of this Monday for a go, no-go on the 12/17 go-live date, based on a plan that they had finished the what's called IT1B testing cycle by Sunday evening. The project wasn't able to do that. IT1B is progressing, but it's not complete as of this date. And so the project has decided that they cannot achieve the December 17th go-live date. They have developed a contingency plan prior to Monday, and as of this Tuesday, that contingency plan is being invoked. And so in terms of what the actual plan is, what the project does not want to do is set another date and then miss that date again. And so what they've been doing is looking, in I say a pretty focused manner, at where the uncertainty lies between today and going live. And you can really split the project into two halves, if you like, or two parts. One is the completion of the development of the software and the initial set of testing of all of those software items. That's where really a lot of the uncertainty and a lot of surprises have been, and where the delays have primarily come from over the last 6 weeks. Once the software development is complete and that initial set of testing is complete, so everything's been tested once and shown to work, it's somewhat more predictable from that point through to the completion of the implementation of the project. So what the project leadership has decided to do is not set an implementation date until that initial set of testing is complete. So basically, the IT1 first set of integration testing, once that is complete, the project will set an implementation date that will probably be on the order of about 7 weeks from that date. But they don't want to set a date out at that point, because if something else happens over the next few weeks that causes another delay, they don't want to have to sort of re-estimate again. So we're actually sort of supportive of this approach, because we've been, I think, pretty consistent since the beginning that we're more interested in the quality of the software than we are of the date that it actually goes live. And really what the project is doing is consistent with that, because what they're saying is we have a set of testing that we have to complete to prove that the software works, and we're going to basically do everything necessary to complete that set of testing, regardless of how long it takes. And at that point, we'll say we're ready to project an implementation date. So we're probably looking at around Thanksgiving when the project will complete that initial set of testing, and at that point they'll define an implementation date, which is likely to be in mid-January, but the exact date won't be known until the IT1 testing cycle is complete. And in order for this to work, and something the project is starting to work on right now, is they need to have a very detailed resource schedule from the beginning of the second set of integration testing, called IT2, through that go-live period, so that 7-week or thereabout period, so they understand exactly who at an individual level is going to be doing what on the project every day until that time, and how the holidays are going to be handled, and to make sure that there aren't any resource contentions either with any of the other business renew projects or with the operational work that's going on in FSB and other areas of the project. So that activity is going on right now, and it should be done, or will need to be done, before the IT1 checkpoint is achieved and they can set an implementation date. So that's a summary of where the project is at this point. Do you have any questions?